Breaking news in the world of tech and finance as CurveBeam AI Limited prepares to take the stage at its highly anticipated annual general meeting next month. The company's 2024 annual report is now out, offering a glimpse into its performance and strategic decisions. But what does it all mean for investors? We'll dive deeper into the numbers and explore the implications for shareholders. Stay tuned. Hopefully. As we delve into the world of corporate governance, it's essential to understand the significance of this concept in ensuring the long-term success of a company. Corporate governance refers to the system of rules, practices, and processes by which a company is directed and controlled. It's a critical aspect of a company's operation, as it helps to ensure that the company is managed in a responsible and transparent manner. The corporate governance statement, which is a key component of the company's governance framework, outlines the framework for the board of directors to conduct its business and oversee management. This statement provides valuable insights into the company's governance practices, including its leadership structure, risk management processes, and compliance with regulatory requirements. But as an investor, it's essential to review the corporate governance statement to gain a deeper understanding of the company's governance practices. This will help you to assess the company's risk profile, its ability to manage risks, and its commitment to transparency and accountability. By doing so, you can make more informed investment decisions and avoid potential pitfalls. But in addition to the corporate governance statement, it's also essential to evaluate the company's leadership team and its track record of governance. A serious team of a strong leadership team with a proven track record of governance can provide investors with confidence in the company's ability to manage risks and make informed decisions. Now let's move on to the world of data in investing. Data-driven investing involves analyzing traditional and public web data to provide investors with specific investment insights, identify patterns, trends, and risks. This approach has become increasingly popular in recent years as investors seek to make more informed investment decisions. The use of data in investing can provide investors with a range of benefits, including improved investment outcomes, reduced risk, and increased transparency. By analyzing large data sets, investors can identify patterns and trends that may not be apparent through traditional research methods. This can help investors to make more informed investment decisions and avoid potential pitfalls. However, the use of data in investing also raises several challenges, including the risk of data errors or biases. Investors must be aware of these risks and take steps to mitigate them, such as using multiple data sources and conducting thorough analysis. Now, let's turn our attention to the impact of genetics on investment success. Well, this may seem like an unusual topic. Research suggests that genetics may play a role in determining an individual's ability to succeed in investing. This is because genetics can influence an individual's personality, risk tolerance, and decision-making abilities, all of which are critical factors in investment success. Because as an investor, it's essential to be aware of the potential impact of genetics on your investment decisions. By understanding your own genetic profile and its potential impact on your investment decisions, you can take steps to mitigate any potential risks and make more informed investment decisions. In addition to genetics, resilience is also a critical factor in investment success. Resilience refers to an individual's ability to withstand market volatility and uncertainty and to bounce back from setbacks. This is essential in investing as markets can be unpredictable and subject to sudden changes. As an investor, it's essential to develop resilience in order to succeed in the markets. This can be achieved through a range of strategies, including diversification, risk management, and emotional intelligence. By developing resilience, you can reduce your risk exposure and make more informed investment decisions. Now let's move on to the growing importance of ESG issues in investing. ESG stands for environmental, social, and governance, and refers to a range of factors that are critical to a company's long-term success. These factors include a company's environmental impact, its social responsibility, and its governance practices. But as an investor, it's essential to consider ESG issues when making investment decisions. This is because ESG factors can have a significant impact on a company's long-term success and can also affect its reputation and brand value. By considering ESG issues, you can make more informed investment decisions and avoid potential pitfalls. In addition to ESG issues, AI is also playing an increasingly important role in investing. The AI-powered investment platforms are becoming increasingly popular as they offer investors a range of benefits, including improved investment outcomes, reduced risk, and increased transparency. However, the use of AI in investing also raises several challenges, including the risk of bias or errors. Investors must be aware of these risks and take steps to mitigate them, such as using multiple data sources and conducting thorough analysis. Now, let's turn our attention to the importance of corporate social responsibility. Corporate social responsibility refers to a company's commitment to social and environmental issues and its efforts to make a positive impact on society. This is essential in investing, as companies that prioritize corporate social responsibility are more likely to be successful in the long term. But as an investor, it's essential to consider corporate social responsibility when making investment decisions. This is because companies that prioritize corporate social responsibility are more likely to be successful in the long term and can also provide investors with a sense of social and environmental responsibility. But in addition to corporate social responsibility, technology is also playing an increasingly important role in investing. Technology-driven disruption is transforming the investment industry and offering investors a range of benefits, including improved investment outcomes, reduced risk, and increased transparency. However, the use of technology in investing also raises several challenges, including the risk of job displacement and the need for regulatory oversight. Investors must be aware of these risks and take steps to mitigate them, such as using multiple data sources and conducting thorough analysis. Finally, let's turn our attention to the need for investors to stay informed. As an investor, it's essential to make up-to-date with market trends and make informed investment decisions. This can be achieved through a range of strategies, including regular market analysis, ongoing education, and the use of reliable sources. By staying informed, you can make more informed investment decisions and avoid potential pitfalls. This is essential in investing, as markets can be unpredictable and subject to sudden changes. Investing out. In conclusion, the world of investing is complex and rapidly evolving. As an investor, it's essential to stay informed and make informed investment decisions by considering the factors we've discussed, including corporate governance, data-driven investing, genetics, resilience, ESG issues, AI, corporate social responsibility.com, and the need for investors to stay informed. Now, as we conclude our analysis of the world of investing, it's essential to consider the various investing strategies that can be employed to achieve financial success. Based on the insights we've gained from our discussion, here are some investing strategies that may be worth considering. First, diversification. Diversification is a key strategy in investing as it helps to reduce risk and increase potential returns. By spreading your investments across different asset classes, sectors, and geographic regions, you can minimize your exposure to any one particular market or sector. 2. People always come down and just to climb up with investments. Risk management is critical in investing as it helps to protect your investments from potential losses. By using strategies such as hedging, stop-loss orders, and position sizing, you can manage your risk exposure and minimize potential losses. 3. The term is this. A long-term focus is essential in investing, as it allows you to ride out market volatility and take advantage of long-term growth opportunities. By setting clear investment goals and sticking to your strategy, you can achieve your financial objectives and build wealth over time. 4. Being people involves active management. Active management involves actively managing your investments to achieve your financial objectives. By using strategies such as stock picking, sector rotation, and market timing, you can potentially outperform the market and achieve higher returns. 5. Passive management. Passive management involves investing in a diversified portfolio of index funds or ETFs, which track a particular market index. By using this strategy, you can potentially achieve lower costs and higher returns over the long term. In conclusion, investing is a complex and rapidly evolving field, and there is no one-size-fits-all approach to achieving financial success. By considering the various investing strategies we've discussed, you can make more informed investment decisions and achieve your financial goals. Thank you for joining me on this episode of NewsPod AI from Big Blue Ceiling. If you have any questions or comments, please don't hesitate to reach out. Till next time, stay informed and keep investing.